Hello everyone, welcome back to Mindful Investing. Today in our stock prediction series, we are talking about Palo Alto Networks, ticker symbol PANW. The stock is down about 5% this year, but there's a lot going on in the background. I'll walk you through my 1 year and 5 year price targets, their key support levels, and whether I think it's a buy right now. I've also updated my stock prediction spreadsheet. In there, you'll see all my past predictions, percentage gains or losses, and for the ones I actually own, my average prices and returns so far. There are also stocks in that list I haven't made videos on yet, so keep an eye out for those. Here's my prediction for Palo Alto Networks. Before you jump in and buy any stock, I highly recommend you understand the company's business model and what drives its revenue. So please watch this video all the way through. Later, we'll break down exactly how Palo Alto Networks earns its revenue and why that's so important for investors. Alright, let's move on to the numbers. I use these key metrics to predict short-term and long-term price targets, and this is the strategy used by Peter Lynch, one of the greatest investors of all time. Palo Alto Networks currently have EPS of $1.75, expected annual EPS growth rate of 20.4%, current PE ratio of 99.3, and current stock price of $173. Based on these numbers, my model gives a 1 year price target of about $209, which is a 21% upside from here, and a 5 year price target of around $439 or a 153% upside. Just last week, I sold a put and got assigned 100 shares at $167.50. I sold them a few days later at $170, locking in about $300 in profit. So, yes, I like the stock at these levels, but I wouldn't call it a screaming buy yet because for me, a screaming buy is something that can give at least 200% returns in 5 years. Still, this is a solid buy in my view, especially for long term investors. And to explain why it's a solid buy, let's move into what Palo Alto Networks actually does and why their business model is so powerful. Palo Alto Networks is one of the biggest names in cybersecurity. They protect businesses, governments, and service providers all over the world with a wide range of security solutions. Here's what they offer. They provide firewalls, both physical devices and software, protect networks. Panorama, which is their management platform that lets IT teams control all their firewalls in one place, whether they are in offices or in cloud. They also provide virtual system upgrades to increase the capacity of existing hardware. And they have subscription services for things like threat prevention, malware and advanced threat protection, URL filtering, laptop and mobile device security, DNS and IoT security, SaaS security, threat intelligence, and data loss prevention. They sell both directly and through partners covering industries like education, energy, finance, healthcare, telecom, manufacturing, and government. And here's a real world example. The company I work for also uses Palo Alto's Global Protect for VPN and security. Once these systems are integrated, they are not easy to replace. That's what we call high switching costs, and it's a huge advantage for Palo Alto's long term business. Now that we know what Palo Alto's network does, let's talk about how they actually make their money. They currently have a market cap of about $115.9 billion with employees over 15,000 people and bring in roughly $8.87 billion in annual revenue. Their revenue is growing at a rate of about 13.9% year over year, which is not great but decent for a company of this size. One important metric to watch here is the price to sales ratio, which for Palo Alto is currently at 12.84. For anyone new to investing, this simply means the market is valuing the company at about 12.8 times its yearly sales. Higher numbers often reflect investors' confidence in growth, but it also means you are paying a premium for that growth. Now, let's break things down by segment. In the last quarter, Palo Alto made about $1.84 billion in total revenue. Out of this, $1.8 billion came from subscriptions, which include ongoing security services like threat prevention and cloud security. And $453 million came from product sales, which are mostly their hardware firewalls and related equipment. When we look at the gross profit, subscription brought in about $1.3 billion, while products contributed around $352 million. What's interesting is that product revenue is starting to gain momentum. It's now growing at 15% compared to being down over 5% just a year ago. On the other hand, subscription revenue growth has been slowing, and that's likely one of the reasons the stock has been trading sideways for the last 2 years. So if you bought this stock in 2023 and held it, you have basically gone on a roller coaster ride. It was up, down, and but ended pretty much flat overall. This is why I'm watching their upcoming earnings closely. If subscription growth starts to pick up again, it could really boost investor confidence and push the share price higher. And there's another big factor. They recently announced the acquisition of CryberArk, which is a leader in identity security. This expands their platform into managing secure identities for both people and machines. It's a big deal, but it's also a massive integration project. Some analysts think it's a smart long term move, others think it's a lot of risk to take on. Acquisitions like this can be a double edged sword. They can bring in new capabilities and revenue streams, but in the short term, they can also create uncertainty, which is likely why we have seen some recent pullback in the stock. Let's take a look at the technical side as well. Right now, Palo Alto is trading below all of its major EMAs on the daily chart, which tells me short term momentum is still weak. But earnings are coming up next week, and I wouldn't be surprised to see the stock bounce back about $200 if the price numbers and guidance are strong. On the yearly chart, the stock is sitting below its 50-day EMA, which is a level many investors watch closely. If we do get a drop after earnings, the next big support zone is between $133 and $146. If it ever falls into that range, I think a lot of long term investors, myself included, would be very interested in buying more. One thing to remember is technical levels are guides, not guarantees, but combining them with the company's fundamentals gives us a more complete picture. So, putting it all together, Palo Alto Network has a strong position in the cybersecurity industry, very high switching costs, and a growing product business that's picking up speed. Subscription revenue growth has slowed recently, and that's something we need to watch in their upcoming earnings. The fundamentals point to solid long term growth, and the technical suggest we are near attractive buy zones, especially if we get another dip. My plan is simple: watch for earnings, monitor their subscription revenue trends, and be ready to buy if we hit those key support levels. That's my full breakdown and prediction for Palo Alto Networks, both the 1 year and 5 year outlook. If you want to see how this prediction compares with the other stocks I've covered, I've made a spreadsheet with all the forecasts, the gains or losses so far, and even my average prices for the stocks I own. I'll link it in the description, so feel free to save it and check back anytime. And if you found this video helpful, make sure to hit that like button and subscribe if you want to follow along with my stock prediction series. I have plenty more companies coming up, including some that aren't in the spreadsheet yet. That's all for this video. Thanks for watching, and I'll see you in the next one.